more. We're joined by Citi's global chief economist, Nathan Sheets, along with Morgan Stanley Investment Management's Andrew Slimmon and Steve Liesman. Gentlemen, welcome. Nathan, 50 basis points, a half point in September and November each. Why do you see that as the likely path? What are you seeing that others aren't?
Clearly, the U.S. economy is slowing here, and inflation has come off the boil. And quite candidly, I think it's time, and at Citi, we think it's time for the Fed to get moving in taking policy to a more supportive stance. Another way to put this is that the risks around the Fed's dual mandate have shifted appreciably. 6 months ago, it was all about inflation. And now the Fed's got to be as worried, and we'd argue even more worried about a slowing economy and the labor market.
So, Steve, do you agree with what Nathan just said, and that is that the economy is slowing? I don't know. Maybe I'm putting words in your mouth, Nathan. Appreciably. Do you see it that way?
I don't see it appreciably. I believe it's slowing. I believe we're getting into that soft landing, and I believe it's really hard for markets, for economists, for forecasters, and for the Fed to sort of separate this idea of an economy that's slowing down in a worrisome way versus one that's slowing down for a soft landing. You don't really know till you get there. The inflation numbers are coming down. I do agree with Nathan in the following way. I think the Fed can cut rates and have almost no impact on its fight against inflation. From my read, I think the Fed is excessively tight given what's happening with inflation. It has indeed become tighter based on its own metrics of following real or the inflation-adjusted funds rate. So I'm not sure the Fed wants a down payment on 50 to start with. I think 25 is fine. The market's pretty confident in 100 this year. I think that makes sense to me to get down to a place where if you need to strike and help the economy out, you're a lot closer to neutral than you are at 540. One other element I would bring in, Tyler, which is sort of informing my thinking, which is I think that Powell will very much want a September rate cut to be unanimous. 50 might send somebody to the dissent side, and I think for the political optics of this rate cut, you're going to want all the voters on board with this. Trump appointees to the Fed, and the Biden appointees.
So I want to get back to Nathan in a moment, but Andrew, I want, in the interest of getting you in the conversation, we're talking about inflation coming down. It has come down, but wasn't the print earlier this week a 2.9% rate? And that is still not the 2% number that the Fed wants. So I have a hard time squaring those numbers with the idea that inflation has been slayed.
Well, we've got two economists on the show, and, I'm just a portfolio manager, but I suppose what the markets are telling you is the direction is still in the right way, and therefore it's bullish. We'll have to see whether there are bumps. I do agree with you that there could be question marks. Right now, the market's seemingly pricing in a perfect landing, which is low inflation, cause Fed to ease, but soft landing, not the economy breaking. And, could either of those be challenged? I think that's possible.
So, Nathan, let me bounce that question back to you, if I might. Inflation has come down, but it is not at 2%, which is what the Fed says its ultimate target is. So is it safe then to start cutting rates, and in your view, cutting rates rather aggressively when inflation hasn't reached that target, is merely directionally moving that way?
I think the key point here is that the Fed doesn't need to see and shouldn't wait for inflation of 2.0%. That the key issue is inflation clearly on the path back to 2%? When you look broadly at inflation indicators, I think pretty clearly the answer to that is yes. And then it's reinforced by the reality that the economy, we can debate how much the economy is slowing, but clearly the economy is slowing, and that's likely to further take pressure off inflation. And as Steve emphasized, the Fed at present is quite restrictive. And even if they cut 25, they cut 50, they cut 100, they're still probably in a restrictive territory. And so the question is, how restrictive should they be as we all agree that the economy is softening and the labor market is loosening?